afternoon and welcome to this virtual audit committee or meeting of Aladale Borough Council. My name's Lee. I'm the Democratic Services Officer, and for the purposes of this meeting, I'm also the host. The meeting is currently being live streamed on YouTube, and a recording will be made available afterwards. Everyone's indicated they're attending is now on the meeting, and we'll start with some introductions. Starting with the members. Councillor Armstrong.
Good afternoon, Councillor Carol Armstrong, Harrington Salterbeck Ward Councillor.
Councillor Bainbridge.
Good afternoon, Councillor Bainbridge.
Councillor King.
Good afternoon, Councillor King.
Councillor Lynch.
Good afternoon, Councillor Elaine Lynch.
Councillor Tyson.
Good afternoon, Councillor Alan Tyson, and I will be chairing this meeting.
Thank you. Just move on to the officers now. Barry Lennox.
Barry Lennox, Financial Services Manager and Deputy Section 151 Officer.
Thank you. And I'll move on to our colleagues from Grant Thornton. Gareth Kelly.
Gareth Kelly, I am your External Engagement Lead.
Richard Anderson.
Richard Anderson, Grant Thornton, External Audit Manager.
Thanks very much for everyone's introductions. Just one more point from me, that I won't have any control of the meeting, and the meeting will not begin until instructed by the chair, which I'll do now. So hand over to yourself, Chair. Thank you.
Right, thank you, Lee. And welcome, ladies and gentlemen of the committee and anybody else who's listening. Okay. Right. We'll start with item 1 of the agenda. The minutes of the last meeting, to sign as a correct record the minutes of the meeting held on 1st of February 2021. Please, if you're quite happy with the minutes, I'll take it as read. If you're not happy with any part of the minutes, please indicate with the raised hand.
All appears okay, Chair.
Right, so I'll assume that you're all happy with the minutes. Okay. Apologies for absence. Item 2.
Thank you, Chair. We've received apologies today from Councillor Hodgson and Councillor Kirkbride and Councillor Campbell-Savers. Councillor Campbell-Savers has been replaced on this meeting by Councillor Lynch. Thank you.
Thank you, Lee. Item 3, declaration of interest. Councillors stroke staff to give notice of any disclosable pecuniary interest, other registrable interest, or any other interest, and the nature of that interest relating to any item on the agenda in accordance with the adopted Code of Conduct.
No, it doesn't appear any, Chair.
Right, thank you. Item 4, questions. To answer questions from members of the public. Submitted in writing by electronic mail no later than 5 p.m. 2 working days before the meeting.
We've had no questions, Chair.
Right, thank you. So we're on to item 5, and Treasury Management Strategy and Statement. And I'll ask Barry to step forward and or bring his chair forward and take us through through this item, please.
Thank you, Chair. Hopefully everyone can hear me all right. As explained in the agenda papers, before the start of each financial year, full council is required to approve a Treasury Management Strategy Statement, an investment strategy, and a minimum revenue provision policy statement in respect of the forthcoming year. It's also required to approve a set of prudential and treasury indicators for the forthcoming and following years. And these have been combined into a single document, which is in Appendix 1, which starts on page 11 of your agenda pack. As with other Treasury reports, prior to its submission to full council, be aware that the council's governance arrangements requires these documents to be scrutinised by the audit committee. Like the mid-year and annual Treasury reports, the content of each of these strategy and policy documents is largely dictated by the requirements of the statutory guidance and codes of practice that together make up the framework for capital finance and treasury management activities within local authorities. The result of that is that the combined documents, the Treasury Management Strategy, Investment Strategy and MRP policy, is quite a lengthy one. And for that reason, the covering report provides members with an overview of the policy and strategy statements, as well as a summary of the recommendations on which member approval is sought. There haven't been any changes to the statutory codes or other guidance since they were last updated in 2017-18. And as a consequence of that, the policy and statutory document in Appendix 1 actually contains very few changes compared to last year. So aside from updating the economic commentary and the interest rate forecasts, the only changes of note are the inclusion of additional commentary related to the PWLB's revised lending terms and a revision to the prudential indicators to take into account the decision by SIPFA to defer the implementation of IFRS 16 in respect of leases to the 22-23 financial year. I'm hoping this is at least the second time people will have seen the Treasury strategy statements, that much of the document will now be self-explanatory. So I'm not proposing to go through each section of the appendix in great detail. However, what I'd like to do is just to provide members with a brief summary of the content of each section, pick up some of the key points, and then give you the opportunity to ask questions on the document. If I can start that review on page 17 of your agenda packs, which is the Treasury Management Strategy Statement, section 2. And this sets out the Council's proposed Treasury management activities for the coming year. It's based on the 21-22 budget proposals, the interest rate forecasts, an economic outlook, and the authority's procedures for managing risks associated with its Treasury activities. One thing to note, the Treasury management investment strategies contained in this document are focused on borrowing and investments in financial instruments relating to the Council's Treasury management activity. So investments in financial and non-financial assets that are made for policy reasons rather than for Treasury management purposes are actually dealt with in the Council's capital strategy. And that will include things like the acquisition of property, loans supporting service outcomes, and investments in subsidiaries and joint ventures. The actual capital strategy document for 21-22 was considered by the executive yesterday and is included on the agenda for the council meeting on the 3rd of March. Section 2.1 provides a summary of the Treasury position as it stood at the end of December. That's followed in section 2.2 by a brief introduction to the limits placed on the council's borrowing activities established through its prudential and treasury indicators, which is set out in more detail in section 5. Moving on to section 2.3, this sets out the interest rate forecasts provided by the council's treasury advisors and provides a commentary on the issues and the assumptions which underpin those forecasts. This is supported by a more detailed commentary, which is set out in Appendix B, on the economic issues currently affecting the financial markets and which have been used to inform those interest rate forecasts. And without going into detail, it's needed to say that those issues are dominated by the economic impact of the COVID-19 pandemic. From the forecast summarised in Table 2, what you can see is that we're not expecting to see an increase in the bank rate at any time during the forecast period, and any upward movement in the PDLB's borrowing rates are expected to be limited. With the bank rate unlikely to rise from 0.1%, which we're at now, for a considerable period, I think it's fairly safe to say that investment returns are unlikely to improve over the course of next year, and will remain at this very exceptionally low level throughout the remainder of this year and into next year, with little increase expected in the following 2 years. Although the upward movement in gilt yields and therefore the PDLB rates over the forecast period expected to be limited, we do need to bear in mind that from time to time, gilt yields can be subject to often quite exceptional levels of volatility, and that could be due to geopolitical, sovereign debt crisis issues, or emerging market developments. And that volatility can occur at any time during the forecast period. PDLB rates are also subject to ad hoc decisions by HM Treasury to adjust up or down the margin over gilt yields that are charged in the PDLB rates. And the last illustration of that was obviously the 100 basis points reduction that we saw in November of last year. As always, those forecasts for PDLB rates are based around a balance of risks, and paragraphs 2.3, 0.23 and 0.24 summarise the potential upside and downside risks to UK gilt yields and PDLB rates, which could cause those rates to under or overshoot the current forecasts. The forecasts in Table 2 were predicated on the assumption of a reasonable trade agreement being reached between the UK and EU by the end of December last year. Having reached an agreement just before Christmas, and so no further revisions to the forecast are required in this regard. The economic analysis and the interest rate forecasting, including Section 2 and in the appendices A and B, were based on the Bank of England's November monetary policy report and the decision and forward guidance issued by the bank's MPC at its meeting on the 4th of November last year. They don't therefore take into account the more recent report, which was issued in February, or the forward guidance issued by the MPC at its meeting on the 4th of February. Similarly, the economic commentary was prepared ahead of the Office for National Statistics issuing its first estimate for Q4 GDP, which came out mid-February, and that showed that UK GDP grew by around 1% in Q4. That follows a growth of 16.1% in Q3, and leaves the GDP level around 7.8% below what it was at Q4 2019. It also means that over the course of 2020, GDP as a whole contracted by fractionally under 10%. That represents the largest annual fall in GDP on record. At its meeting on the 4th of February, the bank left the bank rate unchanged and also left the programme of quantitative easing unchanged. However, it did revise its economic forecast to take into account the third national lockdown, which started on the 5th of January, and which is obviously going to delay economic recovery and is further damage to the economy. On the upside, the forecasts also take into account the improvements to the economic outlook that have been generated by the vaccination programs that have commenced in the UK and elsewhere since the bank's November report. The result of all that is that although the bank's short-term forecasts for 2021 were cut to reflect the tighter restrictions that were imposed in Q1 of this year, the medium-term forecasts are in fact a little bit more optimistic than they were in November. This is based on an assumption that the current lockdown is eased after Q1, as vaccines are gradually rolled out and life can then start to get back to some sort of normality. In the MPC's central projections, restrictions on economic activity in the UK are assumed to ease over Q2 and Q3 and then have to be fully unwound by the end of the third quarter. So what the bank is now forecasting is that the economy will recover strongly from around Q3 of this year and will still reach its pre-pandemic level, i.e. Q4 of 2019 by Q1 of 2022. That's despite that lockdown in Q1. And that spare capacity in the economy will be eliminated by around Q1 of 2022. Having said all of that, the outlook for the UK economy does still remain particularly uncertain, and in particular, it very much depends, as was the case last year, on the evolution of the pandemic, the measures taken to protect public health, and really how households, businesses, and the markets respond to these developments. Following the bank's February reports, our Treasury advisors did issue an updated interest rate forecast to take into account the bank's latest forecast and forward guidance. But this really hasn't resulted in any fundamental changes to the outlook. So the message is that we're still expecting there'll be no increase in the bank rate in the near term, and very little, by the way, of upward movement in the PWB rates over the next 2 to 3 years. The update did, however, result in increase in the forecast borrowing rates right across the yield curve of between sort of 10 and 20 basis points on 5-year maturities, 20 to 30 basis points on 10-year maturities, and between 30 and 40 basis points on the longer maturities around 25 to 50 years. And these reflect a sort of combination of the slightly higher expected rates at the start of the forecast period of between 10 and 30 basis points, and marginally higher increases over the forecast period of around 10 basis points across the yield curve. Looking on to section 2.4, which covers the borrowing strategy, you'll note from the contents of table 1 that the council is currently maintaining what's referred to as an under-borrowed position. And what this means is that the underlying need to borrow for capital purposes, which is measured by the capital financing requirement, has not been fully funded with loan debt. Instead, what the council has done is we've utilised cash balances which support the council's reserves and favourable in-year cash flows to bridge the gap between its external borrowing position and its underlying need to borrow. And this is generally referred to as internal borrowing. What this has done then is it's allowed the council to minimise the costs associated with external borrowing, and also at the same time to reduce treasury risks by reducing its external investment balances. So against this backdrop of low investment returns and the current levels of heightened counterparty risks, this strategy is considered prudent, and the council will continue to adopt this policy throughout 21-22, insofar as its liquidity requirements and its procedures for managing interest rate exposures allow. In order to manage interest rate risk associated with its long-term borrowing, where long-term borrowing is undertaken, it will be done at fixed rates. The issue of borrowing in advance of need is covered in section 2.5, and this is an area that was one of significant debate when the statutory framework was last updated, and indeed it continues to remain an issue of considerable debate, particularly in connection with the use of borrowing to fund commercial property investments. The authority's position is that from a Treasury perspective, and in line with the statutory guidance, it will not borrow more than or in advance of its needs in order to benefit from the investment of the extra sums borrowed. And any decision to borrow in advance of need will be within the forward approved capital financing requirements, i.e. it's done in order to meet the underlying need to borrow from a capital perspective. With regard to the topical issue of borrowing to fund the acquisition of commercial type investments, you'll note that an additional paragraph has been inserted at paragraph 2.5.5 following the implementation of the PDOB's revised lending terms in November of last year. This references the changes made to the council's capital investment strategy and highlights the fact that in order to protect the council's ongoing access to the PDOB as a source of borrowing, the authority will only include in its capital programme capital expenditure on projects and schemes that have characteristics consistent with the PDOB's lending criteria. And the authority will not acquire commercial assets primarily for yield. Further details of the revised lending terms have been set out in Appendix D. Moving on to section 2.6, which covers debt rescheduling. As we've mentioned on previous occasions, the average rate of interest on the council's loan portfolio, which at the end of 2020 was around 5%, is notably above the rates currently available on new borrowing. There's also a market unevenness to the existing maturity profile of the council's borrowing. However, the economic environment that we find ourselves in and the structure of interest rates has limited the council's rescheduling opportunities during recent years. Given the extremely low interest rate environment that we find ourselves in, this situation is likely to continue throughout 21-22, meaning that rescheduling opportunities are unlikely to present themselves over the course of next year. That said, the council will continue to monitor interest rate structures for opportunities to reschedule debt in order to generate savings and or rebalance risks within the portfolio. What we're saying is that the likelihood of those opportunities arising are fairly slim at the moment. The remaining sections of the Treasury Management Strategy, which is 2.7 to 2.9, deal with the council's policy on the use of derivatives in section 2.7. The process adopted for reviewing and addressing the training needs of officers and members, which is covered in 2.8, and the authority's use of Treasury Management Consultants, which is covered in 2.9. Let's move on then to section 3, which looks at the investment strategy. And this sets out the council's policies for managing its Treasury Management investments in order to ensure that it meets its key policy objectives of, firstly, ensuring the security of principal sums invested, i.e. to protect the capital value from loss. And secondly, for ensuring that appropriate levels of liquidity are maintained. In other words, that we can access those funds when they're needed to meet expenditure. Section 3.2 then goes on to explain how ensuring the security objectives will be achieved through the active management of the council's credit risk exposures. And that includes restrictions and limits which we place on who we invest with, in what types of investment products or investment instrument will be used, and for how long investments will be placed. The subsequent paragraphs 3.3 to 3.6 set out further details of these restrictions and limits. But in summary, and as is the case with the current financial year, what we're saying is investments will not be placed with any financial institution that has a credit rating below A-. As for the types of investment products and instruments that we can use, well, you'll see from table 3 that the strategy itself permits the use of quite a wide range of instruments, and that's done to make sure that we've got sufficient flexibility to manage risk and respond to developments in the financial markets should the need arise. However, if we overlay that with the council's risk appetite and its expected liquidity requirements over the next 12 to 18 months, in practice, what it means is that, as with the current year, we'll be continuing to focus on the use of call, and notice accounts, money market funds and short-term deposits up to 6 months in our investment activities. All investments, as this at the moment, will be in sterling. And to limit our exposures to losses arising from the default of a counterparty, we'll maintain our existing limit of £4 million with any single institution or group of institutions, with the exception of the UK Government's Debt Management Office account deposit facility, where the limit is set at 12 million. Finally, as at present, the maximum maturity period for investment reflects 2 considerations. One is the council's cash flow requirements, its liquidity requirements, and the second is the financial standing or the credit worthiness of the counterparty, which is determined using a methodology provided by our Treasury advisors, Link Asset Services. And Table 4 shows the upper limits on investment maturity against the colour rated score, which is derived from Link's creditworthiness methodology. In the current economic climate and in light of the Council's forecast liquidity requirements over the next 12 to 18 months, it's considered appropriate to keep investment short term and to retain the current upper limits on investment maturity of 12 months for all new investments. Moving on to section 4, and this covers the minimum revenue or MRP policy statement for next year. An MRP is an annual amount which, under regulations, the council is required to set aside from its general fund in order to meet the cost of capital expenditure funded by borrowing or through credit arrangements such as finance leases. As in previous years, the content of the MRP policy covers 3 issues. The first is to explain the underlying statutory duty to make a prudent provision for MRP. Second, it looks at the options available for calculating a prudent amount of MRP as outlined in the statutory guidance. And thirdly, it sets out our proposed policy for the forthcoming year. The statutory guidance on MRP, which local authorities have a statutory obligation to have regard to, provides 4 ready-made options as methods of calculating a prudent amount of MRP, although saying that there is no obligation to use them. And these options are shown in Table 5. The proposed policy for 21-22, set out in section 4.3, is essentially a continuation of the existing policy, with the only minor change being to the wording of the 3rd bullet point in 4.3.1, just to reflect the decision by SIT for LASAC to defer implementation of IFRS 16 to 22-23. So under the proposed policy, the council will continue to calculate MRP using the appropriate methods set out in the statutory guidance, options 2 and 3, which in practice means that the cost of any new capital expenditure, which is unfinanced, i.e. been met from borrowing, will be charged to the general fund in equal instalments over the estimated life of the related asset. The final section, section 5, sets out the prudential and treasury indicators for 21-22 and subsequent years, and it includes those required by the Prudential Code, which is set out in section 5.1, and those required by the sector guidance, which accompanies the Treasury Management Code. Those are set out in section 5.2. The prudential indicators are essentially part of a process of self-regulation over capital expenditure and borrowing plans, which is known as the prudential framework. And they're really designed to demonstrate that the council's capital expenditure and borrowing plans are affordable, prudent and sustainable, and contribute to the effective management of treasury risks. The indicators themselves, we start off with the estimate of capital expenditure for the current and following 2 financial years, and a summary of how that expenditure will be financed, and that's set out in Table 6 and 7. Table 8 then shows the impact of this planned capital expenditure and financing on the authority's capital financing requirement, i.e. on its underlying need to borrow for capital purposes. To demonstrate that debt, by debt I mean including borrowing there, will only be for a capital purposes and that the council is not borrowing in advance of need, Table 9 then compares the estimated movement in the authority's CFR for 21-22 in the following 2 years with estimates of its actual level of external debt over the course of 21-22. And that's supplemented by Table 9A, which compares forward projections of the actual level of borrowing and other long-term liabilities with the underlying need to borrow, i.e. the CFR. And that shows that over the next 3 years, the council will remain under-borrowed and well within the upper limit established by the expected movement in the CFR. The authorised limit for external debt, which is set in Table 10, represents the statutory limit on borrowing. In other words, the absolute maximum limit on debt. The council is required to set that under the Section 3 of the Local Act 2003, and any borrowing above that would be ultra vires. The operational boundary, which is Table 11, represents the limit beyond which gross external debt is not expected to exceed based on current forecasts. Both of these indicators are really driven by the estimated movements on the underlying need to borrow, i.e. the CFR, over the next 3 years. And the difference between the two, £2 million, essentially reflects additional headroom which is built into the authorised limit to accommodate any unforeseen borrowing requirements. The next indicator focuses on the affordability of capital expenditure and associated borrowing plans by looking at the impact they have on the revenue accounts. And the ratio of financing costs to net revenue stream in Table 12 highlights the revenue impact of existing and proposed capital expenditure by identifying the proportion of the revenue funding required to meet capital financing costs, that is net of interest and investment income. So the movements in that ratio, which is shown in Table 12, reflect a combination of issues. So we've got the additional interest costs associated with any new borrowing, less the reductions in interest costs from the repayments of principal on existing loans. We've got the additional MRP charges associated with unfinanced expenditure within the current year and the next 3 years. And also we've got the forward estimates of revenue funding, which is included in the medium-term financial plan. It does perhaps need to be borne in mind that pending the outcome of local government funding reforms, so we've got the fair funding review, the move to 75% business rates retention, the resets of business rates baselines, or the potential for an alternative business rate system altogether, as well as the future of the new homes bonus funding, there's significant levels of uncertainty over those future revenue streams. So the estimates which are used in that indicator are subject to the same caveats that we apply to the corresponding values included in the council's medium-term financial plan. The final group of indicators, which are set out in section 5.2, specify ranges rather than targets designed to limit the council's exposure to liquidity and financing risks. And these indicators are upper and lower limits on the maturity structure of its borrowing and upper limits on principal sums invested over 365 days. As I mentioned previously, the maturity profile of existing debt currently highlights a significant portion of maturity loans repayable in around 30 to 40 years' time. But as we said previously, from a Treasury perspective, I mean, we're not considering this to be a significant risk at this time. I think the time frame involved suggests there'll be ample opportunities to reschedule debt before the maturity date. In addition to this, consider that the rate at which MRP is being set aside to repay this debt compared to the rate at which those loans are being repaid, means that sufficient resources will be set aside prior to the maturity date, which actually removes a lot of the refinancing risk associated with those loans. On top of that, where we're taking out any new loans, what we seek to do is to make sure that the period over which the associated expenditure is being charged to revenue through the MRP is in line with the repayment of principal. So in other words, we're setting resources aside so we can meet the principal repayments as and when they fall due. That brings us to the end of the document. I'm happy to take any questions members might have on that document.
Chair, Councillor Lynch first.
I'm on mute, right. Thank you, Barry. Do you want to take it section by section? You know, the TMSS first and then the investment strategy and so on, or?
Yeah, I think that's a sensible approach, Chair. Yeah, if you want to.
Just questions as a whole. Okay. Well, the treasury management strategy and the investment strategy are in sections 2 and section 3, of course. Have we any questions on those?
Chair, Councillor Lynch has a hand raised.
Right, Councillor Lynch.
Thank you, Chair. I have a number of questions on the investment strategy. More specifics to our investment strategy as a council. One of the key things that I don't know whether this is covered in the investment strategy or elsewhere in a financial strategy. How do we ensure that our investments are ethical? Because that is a big thing at the moment. Many commercial companies are being asked by their customers about the investments they make or the products that they're sourcing. How do we know that the investments that we are making are ethical? You know, how do we know that a company that we're investing in hasn't got another company abroad that's investing and making cluster bombs or using child labor or something like that? How do we know that the investments that we're making for the future are in fact ethical? That's my first question.
Yeah, well, part of our strategy, as we mentioned, although we include a broad range of financial instruments that we invest in, in practice, our investments are limited to investments with financial institutions. Now, those are banks and their money market funds who are investing in short-term, short-dated investments. So primarily cash type investments. What we don't do, we don't invest ourselves directly in companies or other entities. So from that perspective, you know, it sort of takes a step back, if you like. We're just putting money effectively into bank accounts.
But how do you know that those bank accounts, that their investments are ethical? Is there a call for local government about investing in ethical? How do you know that they're not investing in?
Well, as another, we can't say where that cash ends up ultimately. We just invest in with the bank. What the bank do, we have no way of tracing that individual investment through to any other investment. It will just be pooled with all the other bank's resources. What they choose to do with that cash is not directly related to our particular investment. It's just part of the bank's wider pool of investments.
So this sort of links to another question. What does our investment portfolio look like? You're saying that you know, can we have a snapshot of where we do invest? Is
Yeah.
there a code of ethics for councils on investment?
We haven't got there isn't one that I'm aware of that we're obliged to follow from a point of view of Treasury activities. And as I say, if we look in terms of our portfolio, at any time we have probably got call deposit with 1 or 2 banks, and we have investments with 5 or 6 money market funds, and we use the UK Government Debt Management Office deposit facility. And that has been the case for a number of years. So we're not making direct investments in any other entities.
So there's no stocks and shares directly in things?
No.
So if we wanted to take funds out of these, investments, how easy is it to do that? Are you allowed?
Well, that's the whole point. Because of our liquidity requirements, we keep our money very short. So we've got immediate access to those funds in order to meet that liquidity need.
Right. So that if you needed it, you would be able to get finances. Yeah. And how, I mean, you did mention about the code and the strategies are now looking at the COVID pandemic and also Brexit, because that also is going to have an effect on finances. Has that changed your investment strategy? Has the COVID pandemic made you change where you invest and how you invest?
It hasn't. We've always adopted a very low risk strategy. So it would be difficult to foresee a strategy that was even lower risk than what we're already taking. Obviously, I think we mentioned previously, the pandemic has had an impact in terms of some of the assessment of counterparties by the credit rating agencies, which are referred to in the document. I mean, that hasn't actually led to any significant downgrades insofar it was affect our ability to invest with the existing group of counterparties, but it's obviously something that we keep a very close eye on, and we're updated immediately if there were any changes to credit risks. So if one of those institutions dropped below the minimum credit rating that we specify, and as I said, we've got immediate access to those funds. We could immediately withdraw funds from that counterparty in order to address that issue.
But just going back to the ethical investments, is it something that we should maybe be exploring as a council, particularly in the light of present circumstances and various things going on in the world? Is it something that we as a council should be doing?
Well, I think if you look at it from a practical point of view, if you look at the group of counterparties that we invest in, i.e. the high grade financial institutions and money market funds, if we were to withdraw from using those, it's difficult to know where we'd actually invest the funds.
Yeah. Okay, thank you.
Yeah. I was just going to say, Councillor Lynch, perhaps we ought to make a confession to Barry to some extent that part of our interest, of your interest and my interest, is because we're both on the Climate Change Committee. Yeah. And that I certainly noticed, Barry, in your review, that we use the firm Link as investment advisors.
Yeah.
Now, I know that Link are doing a fair amount that they're making public on ethical investments. For instance, you know, firms or organizations that don't want to invest in fossil fuels at this stage. Would it actually be possible to make some sort of investments in that direction advised by Link?
I haven't seen what advice that they've put out there, but I think any additional counterparties would have to fit within the structure of what we've already set out in terms of the minimum credit ratings of those institutions. Bear in mind that what we're investing in are financial institutions as opposed to non-financial institutions. Clearly, I think that issue around ethical investment probably becomes a little bit more relevant when you're talking about, say, pension funds, which are themselves investing directly in equities within companies, but that's a sort of separate matter.
Yes.
Can I just ask a follow up to that then? So, what about the pension funds? Because that is obviously a financial investment as well. Maybe we should we have a report to this committee as to what the nature of the investment in pension funds, and are they ethical? Is there a code for that?
Well, we're stepping outside of the treasury management remit for us as a council. That's an issue for the pensions they do set out their own policy on ethical investments. That's publicly available, and how they manage invest ethically.
Okay, thank you.
Yeah, Barry, would it be possible for us to discuss these ethical investments with you at some stage, outside the meeting, of course, not as part
that's
of
not
this
a problem.
Meeting. Right, okay. Because I think perhaps the way ahead that we can understand these things better. And I certainly have some information on what people are doing on ethical investments, and with regard to pension funds. Well, thanks very much for that anyway. Thanks for bringing it up, Elaine. Okay. Do we have any more questions?
It doesn't appear so, Chair.
Well, that was on the investment strategy. Are we happy with the MRP policy statement and the understanding of the MRP? Well, it sounds as if we are actually. Okay. And then the final part was the prudential and treasury indicators, which Barry went through in excellent detail, and the council's authorised borrowing limits in section 5. So does anybody have anything to ask on that at all? No? Okay, well, thank you, Barry. It's then up to me to recommend that members approve of these items. The Treasury Management Strategy Statement, the Investment Strategy for 21-22, the MRP Policy Statement in Section 4, and the Prudential and Treasury Indicators, including the Council's authorised borrowing limits. That's a long sentence. In Section 5. So if we're all, I'd like to recommend that members approve of these items and that we can take them forward to the full council meeting next week. No, sounds as if everybody's happy. Okay. So we've got approval on that, right? Thank you very much, Barry, because it's, as ever, it's a pretty full report and thorough report that you give. Thank you. Right, now we come, I guess, to item 6, which is our friends from Grant Thornton and the annual audit letter for 1920, which we
Yes.
know already you've put a lot of hard work into, actually.
Yeah, yeah. Thank you, Chair. I'll take the report just at a high level, and Richard will then provide any areas of detail. The annual audit letter is a summary of our work for the 1920 financial year audit, and really we won't go into too much detail because this is really a letter that summarizes what we already presented to you as those charge of governance back on the 28th of November. So it's really just summarize the completion of that work. In terms of the actual broad responsibilities that I have as your appointed auditor, it's split into obviously giving an opinion on your financial statements, giving a conclusion on the value for money and the authorities' use of resources, and whether or not I've had to use any of my other statutory powers under the Local Audit and Accountability Act for 2014. So I'm pleased to report across the board that it is a positive position. We were able to give an unqualified opinion on the council's and its group's financial statements by the statutory deadline of the 30th of November. There were a couple of emphasis of matter paragraphs, which again, we've taken the committee through previously, which were connected to uncertainties, material uncertainties around the valuation of property, both in terms of your own property base and your share of the pension fund's property base, in terms of as a direct result and impact of the coronavirus pandemic on property markets. So again, that wasn't a qualification on your accounts, it was merely just us emphasizing that material uncertainty. So in terms of overall position was a positive one on the accounts, likewise on the value for money arrangements. We were able to give a clean, unqualified opinion on that, and pleased to report that I didn't have to use any of my other statutory powers for the 1920 financial year, which meant when I was given my opinion on the 30th of November, I was able to provide my certificate as well of closure of the audit for 1920. So that's it at a high level. I'll hand across to Richard if Richard just wants to take you through some of the more salient points in the report, and then Chair, we're happy to take any questions. So just across to Richard first.
Thank you, Gareth. So I'm going to talk through just like the key risks on the financial statements and value for money audit, and then I'll just touch on the final audit fee. So starting on page 6 of our report is where we highlight where the significant risks for the financial statements audit were. And these were in relation to the impacts of COVID-19, as you'd expect, the valuation of land, building and investment property, management override of controls, which is a presumed significant risk on all audits, and the valuation of the pension fund net liability. And then there's a second presumed risk on all audits around improper revenue recognition, and we were able to rebut that risk on this audit given the nature of the council's revenue streams. The key message in relation to the significant risk of the financial statements audit is obviously we carried out the work as described in the report and as we've previously discussed with you, and with no significant findings to bring to your attention. With the proviso of the 2 points there that Gareth raised around there being material uncertainties on the property. So overall, this reflected that the accounts were prepared to a very high standard, and there were very few changes to the accounts and no significant findings in relation to those significant risk areas on the accounts. Turning to the value for money, this is in our report from page 10. As Gareth said, we were satisfied that in all significant respects the council put in place proper arrangements to secure economy, efficiency and effectiveness in its use of resources for the 1920 year. As we outline in the report and as we previously discussed, we had 3 key areas of focus in our value for money work around the overall financial sustainability and financial resilience of the authority, the arrangements in relation to the Workington Community Stadium project and decisions made in relation to the stadium project during the 2019-20 year, and also looking at the waste and recycling contract and related procurement arrangements. As we've previously discussed, we carried out some detailed work in this area, and as we try and outline in the annual audit letter, that we did have to do some detailed work to reach the unqualified value for money conclusion. We engaged our national Grant Thornton consistency panel, and there were instances through the year where we identified some weaknesses in arrangements, and off the back of this we have raised 3 recommendations which were previously discussed with the committee, but overall we were satisfied that the authority's own arrangements had identified areas for improvements in relation to the stadium project and the waste contract, and that actions were beginning to be taken during the 1920 financial year and onwards in the current financial year. And it was on that basis that we were able to give the unqualified value for money conclusion with the recommendations that we made. So I know we've gone through each of the risks in detail at the previous committee, so just reinforcing that message. The final element of our report is page 14, where we just confirm the actual audit fee for the year. This is the same fee that was reported in our audit findings report, and here we just go into a little more detail on the factors that led to the difference between the scale fee, which is the initial fee that was set by public sector audit appointments when we were appointed as the council's auditor, and the final fee charged. As you can see there, that some areas relate to just the change in quality expectation for external auditors, particularly around areas such as the valuation of the pension liability and the valuation of land, building and investment properties. But you've also got the additional work that we did in relation to the value for money significant risks and the impact of COVID-19, both on the complexity of our audit, but also the reality that delivering an audit 100% remotely, as we did this year, it does take a significant amount of additional time, and that's reflected in the additional fee charged. The final point to just say on the audit fee is that is subject to final approval by public sector audit appointments, and that final approval has not yet been provided, but that process is in action at today's date. So that's all I was going to say about the annual audit letter. It is just a summary of information we've already discussed and presented to this committee before, but I'm more than happy to take any questions on the detail of the report. I think you're muted, Chair.
Chair, you're on mute, and when you're unmuted, Councillor Lynch has a hand raised.
Right, Councillor Lynch.
Thank you, Chair. Just lower my hand. On page 7 of your report, in the findings and conclusions, this is in the evaluation of land, buildings and investment property. that the council's investment property balance included an asset under construction at a cost of 212,000. I don't know what that asset is. What is that asset? What asset are we talking about?
Barry might be able to give specific.
Yeah, from working from memory now, that was the cost that we'd incurred on the Reedlands Road project that was ongoing at the time.
Sorry, which project?
Reedlands Road.
The Reedlands Road project. And that's what was incurred at the time.
Yeah.
Okay, thank you. And a second question on page 13. And this is the value for money on the waste and recycling contract and procurement arrangements. In the findings, the next to last paragraph, it talks about review of the Programme Management Office and task and finish groups and various recommendations and things that clearly sort of like a lessons learned report. Where are those recommendations? Because I've never seen any of those recommendations that have come out of that. You clearly have, because you, in your conclusions, you said that those recommendations are now going to be followed. Where is this report that the Programme Management Office and the the procurement task and finish group have done? Does anyone know?
Barry, is that something you can answer to or take away and provide that information for Councillor Lynch?
I'd need to come back to you on that because I wasn't party to the report itself.
Yeah, I might be able to find the documentation that Councillor Lynch is referring to as well.
Because I think that ought to come back to this committee so that this committee knows what the recommendations are, so that we can, in our function as audit, be able to check that these recommendations are actually being followed.
Yeah, I believe that some of those recommendations have gone to executive from the Overview and Scrutiny Committee. A lot of it's on the Overview and Scrutiny agenda, but what you've mentioned, I'll get that, take that request away and get that paperwork for you.
Because I think that's a very important part of, clearly it's been highlighted in the report, and this audit committee ought to be able to have a copy of that report and be working towards that when we're looking at future procurement, etc.
Yeah, I'll take that one away and chair. Through the chair. Thank you.
Thank you very much.
Thank you. Could I just ask if those would go to overview and scrutiny because they were capital projects?
The reason why they go through overview, if you're talking about task and finish groups, they are from overview and scrutiny. So they create, yeah. So basically they're implemented through scrutiny, and the membership is open to the wider council. That's why I think yourself will be. You mentioned earlier that you're on the climate change group. So yeah, that's why they come from overview and scrutiny, and then the report goes back to overview and scrutiny as well. So in other words, that's the finish element of the group.
Right. Thank you. Thank you very much, Lee. Yeah. Okay. Well, I enjoyed reading this report through again, actually, as we had it in November, and I remember we were quite satisfied so far. Well, when we heard the full story and why you put such a lot of work into November, which I'm sure we're very grateful for, and it's good to see the years more or less being rounded off okay. And I think, yeah, hopefully we can all learn a few lessons from it.
Yeah, definitely, Chair. Just to conclude it, I mean, I want to pass on our thanks as well to the council for their responsiveness, you know, Barry in particular on the account side, and Catherine and the team, you know, on the value for money side, because yeah, as we've outlined, it has been a challenging year with COVID layered on top, but it was a very, very good position to get to, in line with the statutory deadline. Just to say that is not a position that we've been able to achieve across our portfolio of local government clients nationally, both as both as an audit provider and across all audit providers for that matter. It has been really challenging, so it has been a very pleasing position to get to. And just on that last point that Councillor Lynch has made, I think it is valid that you as a committee are cited on those related recommendations and to take those lessons learned going forward. But just to pass on our thanks to you as a council as well, Chair. So thank you.
Yeah, Chair, Councillor Lynch would like to come back in. Thank you.
Yeah, Councillor Lynch.
Thank you very much. I would just like to pick up on a point you said earlier, where you said the accounts had been prepared to a high standard. And I think we ought to minute the fact that the council have worked really, really hard on this. And for you as a group to say that they were prepared to a high standard, I think we should congratulate our finance department, and if Barry can take that back as well from this committee, because I think, you know, it has been a difficult year, as you just said, but the fact that you are saying these were prepared to work to a high standard, they've worked very hard on the value for money, and I think this committee should recognise that from our finance department.
Right, Councillor Lynch. So are the other members of the committee happy that we put a statement in along those lines?
Yes.
Thanking both our finance department and particularly Grant Thornton for looking after us during the year, because we've obviously had a lot of support from them. Okay. Right, so with that, I guess I can declare the meeting closed. So thank you very much, everybody, for attending, and we look forward to the one in a month's time. Okay.